As we all know, there was a huge rally in the market on Wednesday following the results of the presidential election. Oil companies, tech companies, financial companies, and a lot of different sectors soared on the news regarding Trump's victory. But there was one stock in particular that didn't get to benefit from the market surge, which was Realty Income. While much of the market was soaring that day, this company's stock fell by over 4.5% at certain times, making it among the rare losers of the day. Although REITs in general performed poorly on Wednesday, there was no question that Realty Income performed much worse than average in this sector. We already know the Federal Reserve announced their first interest rate cut back on September 18th, and REITs are one of those sectors that benefits more from lower interest rates. And we can see that following the announcement, Realty Income was moving higher, up to nearly $65 a share. But their stock recently fell following their earnings announcement a few days ago. As it turns out, the numbers they post were considered worse than expected, and this resulted in a pretty sizable sell-off for them. So let's go ahead and run through the numbers they just released and try and determine what exactly is sending this stock down so much over the past few days. This will also be good practice if you've ever wanted to know how to analyze a REIT, because this company in particular, Realty Income, makes their financials easier to read than other companies in their sector, from my experience at least. So first things first, Realty Income announced their FFO per share was 99 cents according to this title, and it was missed by 7 cents. Funds from operation is the key metric used to analyze a REIT, which is net income plus depreciation plus amortization plus property sale losses. You then subtract property sale gains and interest income. The reason why REITs have this special metric is because they usually only earn revenue from their real estate. You can't use the same metrics that you would use on a company like Coca-Cola or Pfizer. And when it says misses, that means analysts at financial institutions forecasted this company to earn roughly $1.06 FFO for Q3 of this year. Regardless of the company, if a stock misses expectations that are set by these institutions, this usually sends a stock's share price falling. If we look at their FFO per share over the past few quarters, we'll see it was growing very consistently. In the previous quarter, Q2, they reported $1.07 FFO. In Q1, they reported $1.05, and in Q4 2023, they reported $1 FFO per share. So things were moving upwards very consistently for this company, but all of a sudden we had one quarter off here. This is a good time to point out that there is another metric to look at besides FFO, and it's actually better, which is called AFFO, or Adjusted Funds from Operation. There's currently no requirements for REITs to report this metric, and as a result, not all of them do. I would say the majority of equity REITs do report AFFO, and some will only report AFFO once in a while, like once or twice a year. But fortunately, Realty Income makes this metric easily available. You can see that while FFO was only 99 cents, their AFFO was $1.05. This is much better than what the headlines are reporting, which typically looks at FFO. Now that we have AFFO, we can now easily calculate their payout ratio. To know what a REIT's dividend payout ratio is, you take the quarterly dividend amount and divide it by the FFO, or even better, AFFO if you have it. Realty Income pays monthly dividends, so first we have to multiply their monthly dividend by 3 to get an accurate number. 26.35 cents times 3 is 79.05 cents. Now we can find their payout ratio using simple division. The vast majority of equity REIT analysts will tell you that these companies like to keep their payout ratios between 70 and 80%. Right now, Realty Income is reporting a payout ratio of 75.2%. This is considered right in the middle of the ideal range and thus can be viewed as healthy. Despite the panic selling and the lower reported FFO, Realty Income's dividend is not in any kind of danger. They've already grown their distributions 4 times this year, which is really unusual for them. They typically only grow their dividends 4 times a year, and we're not in December yet, which is when they also usually increase it again. Let's look at some other metrics that are important for an equity REIT. There's been a lot of concern regarding the occupancy rating for this company. As I've covered in the past, a number of their tenants have been closing a number of stores. Some of them have already started, but a lot of people have been scared off from this REIT because of that. As of September 30th, 2024, their portfolio occupancy rating was 98.7%, with 196 properties available for sale or lease, as compared to 98.8% for both periods as of June 30th, 2024 and September 30th, 2023, respectively. They also provide this useful chart in their investor presentation, which shows their long-term average. You can see here that right now their occupancy rating is better than it was last year, and their long-term median occupancy is 98.2%. So they're doing even better compared to their long-term norm. For comparison, the average equity REIT in the S&P 500 has an occupancy rating of just 94.2%. Realty Income's occupancy has never been that low in its entire history as a publicly traded company. Although I do think it's still too early to know how much this REIT will be impacted by these closures, they're still outperforming their long-term average. Since we know occupancy isn't an issue here, how about same-store rental growth? It's also good to look at because this is how much Realty Income can grow the rent on their existing clients. According to their press release, they did grow it, but slightly less than the previous quarter. In my opinion, I don't think this is a contributor to the sell-off we've been seeing. I know there's been a lot of discussion as to how quickly this company will be able to grow going forward, considering how big Realty Income has already become. I still don't think that this is an issue for this company, and I don't think it will be for a very long time. A lot of people just seem to overlook the fact that this company has been expanding into a lot of other countries right now. Their WALT, or their weighted average lease term, hasn't really changed at 9.4 years. This is how long the average tenant is locked into a lease with Realty Income. Debt also doesn't appear to be an immediate threat to this company either. In fact, as interest rates go down, then things are going to look much better for them. But what I think is likely the biggest contributor to the sell-off besides the FFO miss was the increase in expenses they reported. As a result, they actually forecasted that they might end up spending even more than what they originally estimated. They now expect property expenses to be between 1.2 to 1.5% of their expected revenue. That's a slight increase from their 2024 guidance of 1 to 1.5%. Finally, if I'm concerned about something the company released in their earnings, what I usually like to do is listen to their earnings call. This is where the CEO discusses how the company is doing and he answers questions. This is what I thought was the most important thing that I want to quote from the call, starting with their projected outlook. To quote Sumit Roy, Realty CEO, "We are raising the low end of our AFFO per share guidance for the year to a range of $4.17 to $4.21. Despite some recent volatility driven by exogenous factors, we remain confident in our strategic vision and the opportunity ahead. Our investment strategy offers significant opportunities for growth across multiple verticals, including our core of retail and industrial, and newer verticals such as data centers and gaming." So this company gave a forecast as to how well they think they do this year, and they're now updating it to be more optimistic. Ultimately, I'm not concerned about their latest results, especially since interest rates were just cut again yesterday. We will have to wait and see about their tenants closing stores, but I have confidence in Realty Income's ability to only buy good locations, which Realty Income does a lot of due diligence on to make sure that they aren't buying stores with poor performing tenants. But with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.